first item of business is the annual report.
Great. So I will dive right into the PDF. I'll take you to page 6 of the agenda document. It's page 2 of the Police and Fire Report. It's just a synopsis of market returns for calendar year 2018. Dan, do you want? I have a hard copy. Okay. I just don't want to be responsible for your optometrist getting a new boat.
Everything else is taken out of it.
What about me?
So, it's funny, we talk about things through today, and it's a starkly different story in terms of the recovery we've seen so far here in 2019. But the end of 2019 was a stark reminder to investors that markets can, in fact, turn negative, and to a pretty extreme degree. If you take, for example, the S&P 500 from peak to trough, that peak was September 20th. So we actually started the market decline at the tail end of the third quarter, but July, August, and the front half of September was strong enough that the third quarter was still positive news. But the peak of the market from an S&P 500 standpoint, and really every metric, whether you talk about mid-cap stocks, small-cap stocks, international, was September 20th. With the low being just after Christmas. We kept waiting for a Santa Claus rally, and that came after Christmas, and we saw a pretty strong rally into the end of the year. If you look from a peak standpoint to a trough standpoint on a market close to market close, the decline on the S&P 500 was 19.36%. So from a Wall Street definition standpoint, that's a correction, not a bear market. A correction is 10% or greater. Bear market is 20% or greater. If you go from intraday, and I realize this really gets down to splitting hairs, but you go from like 2:04 p.m. on September 20th to 11:12 a.m. on December 27th, we were down more than 20%. So by all measure, we entered correction territory. Now that's limited just to the S&P 500. If you talk about small cap stocks, we were in correction territory. If you talk about international markets, we were in correction territory. So we were down in excess of 20%. Now, I will tell you that, for example, the rally we've seen so far here in 2019 is about 2/3 of that's been made back. So round trip, small cap stocks were down 22 or 23. They're now down about 6 or 7. If you go from kind of October 1 through today. So with the rally we've seen so far here in 2019, a good chunk of that's been made back, but still in negative territory for that roughly 4.5 months. So the one surprise I will tell you during the quarter, large cap stocks down 13.5, small cap stocks down 20.2. International developed was down 12.5. The one surprise was that emerging markets were only down 7.5%. We actually saw a rally, or a little bit more rally near the end of the year, and just less pain and things from an emerging market standpoint. But we did see international markets outperform U.S. markets during the fourth quarter. In a reversal, not a big surprise, we saw interest rates actually decline tail end in the fourth quarter, right? Markets are in negative territory, flight to quality. So the U.S. aggregate bond index for the month of December, for example, is up 1.84, and for the quarter was up 1.6%. For the calendar year, it was basically flat. With the rally we saw, particularly in December, the year-to-date return was 0.01%. That came out of things like treasuries and agency bonds, true high-quality fixed income. Because you look, for example, investment-grade corporate bonds for the quarter were down 0.18, and for the calendar year were down 2.5. So even in high-quality fixed income, corporate bonds were actually in negative territory, as it was a true risk-off environment. And you see that in high yield as an example. For the quarter was down 4.5 and down a little over 2% for the calendar year. We did see rates across the year go higher. You see that, for example, the 3-month went from 1.38 up to 2.35, almost a 1% increase. You look back to 2016, 2015, 2014, the conversations we're having really from a treasury standpoint is municipalities are actually finally seeing, excess cash actually generate a return that's being used to plug budget holes. Right, for a long time, from a cash reserve standpoint, you were earning 0. And in many cases, banks were waiving fees just so that you stayed flat. Now with this recovery in rates, we're finally seeing cash as a return-generating investment and starting to see an actual contribution to city budgets in terms of the income being generated by excess cash being held. What worked worked and what didn't, bottom left-hand corner, you see from a year-to-date sector standpoint, it was funny, coming into the fourth quarter, 11 of the 13 sectors were actually in positive territory. Coming out of the fourth quarter, only 3 were in positive territory. Healthcare, utilities, and consumer discretionary were just barely positive. You see names like industrials down 13, materials down 14.7, and energy down in excess of 18%. And that decline in energy doesn't come as a big surprise when we drive around and see gas prices pretty consistently hovering around $2 a gallon. One change we did make this quarter is if you see on page 7, the traditional executive summary exists on the bottom half of the page, but we also added just a paragraph on commentary on the markets, just to kind of bring from a synopsis standpoint. The thought being is if you just have a couple minutes to get a quick snapshot on the health of the system and health of the markets, you can go to this page and see, all right, here's what happened in the markets, here's some brief economic commentary, some brief interest rate commentary, and then specific portfolio comments. Thought being is this is also something that could be easily pasted into the minutes in terms of in 10 lines summarizing what we've talked about for the last 7 minutes. So what worked and what didn't? I'm going to flip you ahead to page 6. And we see for the quarter, the police and fire retirement system was down 7.38%. We did trail the policy index by a slight margin that was down 7.19. That's really attributed to underperformance from the 2 Loomis fixed income portfolios. While that number is disappointing on an absolute basis, right, being down 7.4%, it is interesting on a comparative basis versus peers. It ranked in the 19th percentile, meaning 81% of public plans did worse for the quarter. On a calendar year-to-date basis, for all of 2018, down 4.44%. We did outperform the policy index that was down just over 5% and ranked in the 55th percentile. Or put a different way, I'm learning this because I have young children. You want your children in the 99th percentile, not the 1st percentile for different things. From a ranking standpoint, specific to investment managers, and these lower is better. So that 45th percentile means you outperformed 55% of your peers for the calendar year. So what worked and what didn't? We see the S&P 500 was down 13.5% for the quarter. Interesting, every time we see market volatility come back, it becomes this drawn-out debate of, well, active management should shine, active management should shine. The benchmark ranked in the 31st percentile. So 69, almost 70% of active managers underperformed the S&P 500 during the quarter. S&P low vol had a really nice return, down 5.2%. See, that actually ranked in the 1st percentile. It was actually positive for the calendar year, up 0.2. Small mid-cap allocation that was introduced, you see, was down 18.2%. As I'd mentioned, a good chunk of that loss has been recovered so far here in the first quarter. From an international equity standpoint, Vontobel, that seems to be doing well, then struggling, doing well, then struggling, doing well, then struggling. From a quarter-to-quarter basis, outperformed for the quarter, down 10.75% versus their benchmark that was down 11.4. See, they ranked in the 39th percentile. For the calendar year, they were down 11.9, almost 12%, but outperformed their benchmark that was down effectively 13.8, and actually ranked in the 20th percentile. So did very, very well versus their peers. Longer-term returns for them continue to remain strong. New addition, increasing that international equity allocation, you see the Vanguard Developed Markets Index was down 13 for the quarter, ranked in the 43rd percentile. And then finally, really the cause of the underperformance for the quarter from a fixed income standpoint, which is understandable given the exposures that Loomis has in their fixed income portfolio. You'll see the Loomis fixed income was up 1.36%. Sorry, I misspoke. It's just we keep talking about negative returns, negative returns, negative returns. So you see Loomis fixed income was up 1.36%, but they did trail their benchmark that was up 1.65. The sole reason for that underperformance, and is part of the reason that we think so highly of Loomis, is there's a lot of corporate credit in that portfolio, a lot of corporate bonds, right? One of the biggest strengths of Loomis as an organization is their bond research. So a good chunk of their portfolios, whether it's in the high income fund or in this more conservative institutional fixed income fund, is in corporate bonds in their underlying credit research. So as we'd mentioned in talking about what happened in the first quarter, while fixed income was in positive territory, investment-grade corporate bonds were actually in negative territory. So the fact that even though they're overweight corporate bonds in that portfolio, they were still up 1.36 was a strong quarter for them. So always disappointing to see underperformance, but we absolutely understand why they underperformed. And the reason for the underperformance in the in the fourth quarter is the reason for their underperformance for the calendar year and longer term. It's that corporate bond allocation in that portfolio. Within the high income fund, so the high yield oriented portfolio, we see they underperformed for the quarter, down 6.16 versus their benchmark down 4.5. Underperformed as well for the year, down 3.5 versus their benchmark down 2.1. Longer term results continue to be very, very strong for them. You see, for example, going back to 2012, they outperformed by about 1.2%. One thing I will note, if you flip back to page 5, is looking at this from an asset allocation and investment policy statement compliance standpoint, the real estate allocation is over the maximum limit of 10%. Recall, we were over at the end of September, and at the November meeting, we approved a rebalance that included a redemption from the UBS fund. That has been entered. From a timing standpoint, that becomes effective March 31st. So corrective action has been taken to remedy this. I just want to make sure we point that out to the extent that somebody looks at the minutes or looks at the report and says, hey, wait a second, it's 2 quarters in a row that you were over your maximum 10%. What are you doing about it? Corrective action's already been taken. Final piece on page 7. Within the real estate standpoint, the UBS Trumbull Property Fund was actually in line with their benchmark for the quarter. You see up 1.73 versus their index up 1.76. We have seen returns from a real estate standpoint start to moderate a little bit. That's not to say we have expectations of them turning negative, but as interest rates have risen, there's been a little bit more pressure on cap rates or on prices from a real estate standpoint. So this idea of having double-digit returns going forward, we think is a little bit far-fetched, but should continue to see mid to high single-digit returns. And to the extent things slow even more, recall from a conservative versus aggressive standpoint in core real estate, UBS is second from the left, right there. In terms of the universe of core real estate funds, there's only one that we're aware of that's more conservative than the UBS fund, and that conservative measure really comes in the form of less leverage. Less leverage hurts on the upside, right? Leverage magnifies returns, so them having less leverage in a year where real estate is rallying really, really well means they're going to lag a little bit. But to the extent we see a slowdown or see any difficulty from a real estate standpoint, that lower leverage is going to help them significantly. So with respect to performance, that was the extent of my prepared comments. I'll pause and see if there's any questions. General? Sorry, flip over to ERS. So this I will go to, start on page 51 of the PDF package. This would be page 5 of the ERS report. And this is really just for the sake of the minutes, just making sure we state at the end of December, everything but real estate was in compliance with the investment policy statement. We were over by 0.7%, but we have entered a redemption from that UBS fund, so corrective action has been taken. That is reflected in the executive summary, but just want to make sure that we state that on the record for the meeting. So I'll flip you ahead to page 6, which is page 52 of the PDF, specific to the employees' retirement system. So recall the prime difference between police and fire and ERS is a little bit less of an equity allocation on the employees' retirement system side and a little bit less from an international equity standpoint. And you see that bear out in returns. So for the quarter, the employees' retirement system was down 5.84%, slightly trailed the policy index that was down 5.58. Again, the primary reason for that underperformance versus policy index was the 2 Loomis fixed income portfolios, but ranked in the 14th percentile. On a calendar year-to-date basis, down 2.46%, slow outperformance versus the policy index that was down 2.73, ranked in the 18th percentile. It's been a really interesting conversation with clients, specifically those with a December 31st fiscal year end. So if you think about it, trying to get to call it a 7% return, right? We were down 2.5. 82% of systems were down more than that. And the median plan for the calendar year was down 4.5. So in terms of conversations around funding and what calendar year 2018 means, if this was your fiscal year end, which is for some counties and a lot of townships, this wasn't, because of the fourth quarter, this was not a good year from a funding standpoint. Other the nice thing is if you look out longer, there are a number of gains embedded that should help smooth that, but if we were having a conversation, this was the cutoff from an actuarial standpoint, this would be a year of losses that we'd be smoothing in. Questions on performance? Give you an idea so far this year. This is through last night's close. The S&P is up 9.4. Small cap stocks are up 13.3. Developed market international stocks are up 7.5. Emerging market stocks are up almost 9. So you've seen a pretty big rally so far here in 2019. The risk of Tom having to hear some of the same jokes repeated. We're having this conversation in the January meeting. You recall the headlines in early January were 2018 was the worst year for stocks since 2008, which is technically true. But from a comparative basis, the S&P was down 4.5% last year, not 37. Now what's funny is you fast forward to February, and the headlines in early February were January was the best start for stocks since 1987. Which is true, and it was a great year, but when you read those headlines and then take it back and actually distill down and see where the results are, nobody's happy about 2018 in terms of seeing negative returns, but on a comparative basis, being down 4.5 is a lot less. Actually, on a calendar year basis for the S&P 500, if you go from the 20s to present, if it's a negative calendar year, the average decline is in excess of 13%. So being down 4.5 was well above average, just to kind of put things in context. Our expectation going forward is that 2019 should be a positive year for stocks. There are so many things from an underlying fundamental standpoint. Yes, we've gotten through what is hopefully the first and only shutdown of the federal government in this budget cycle. It's absolutely amazing, and Casey, this may be something that hits home from your standpoint, but I was having a conversation with an Auburn Hills police officer, and he commented that, I'm getting my paycheck, but a lot of my coworkers on the FBI detail that I'm on haven't. And he said the one thing that a lot of people have forgotten is I have a lot of informants that are not getting paid. And while these people are providing me valuable information, they're not providing me this information out of the goodness of their hearts, because they're not really good people. They're providing this because we are paying them for it. So he said there's going to be a lot of cases that we were working on that just went cold. It's just amazing to me hear some of those anecdotal pieces of you see everything from a national park standpoint and going through all that, but hearing some of the other things closer to home. So with respect to performance in the markets, that's the extent of prepared comments. We do have a little bit we want to discuss on liquidity and the small cap allocation, but I will pause and see if there are any questions before we shift gears.
Is there a motion to accept the report of the police and fire center? Yes. Yes. Next is the liquidity, right?
Great, so I am on page 80 of the PDF document. 80. So this is liquidity plan for the employees' retirement system. So this is something we're continually revisiting just to make sure that we have sufficient cash. And the cash needs on a month-to-month basis are different for the employees' retirement system versus the police and fire system. So you can see, for example, at the end of January, we had cash balance of about $189,000. By our estimate, because of the pending cash flow coming from UBS for that redemption, as well as quarterly income payments that come from that portfolio, we need to revisit again, definitely at the August meeting. We project a shortfall come August, just in terms of spending down that cash. But we'll plan to bring this back again in May, just for a revisit to see if we need to take any action. But specific to the employees' retirement system, no action needs to be taken because the current cash balance we're projecting to be sufficient to cover benefit payment needs for the foreseeable future. On the police and fire side, We do have a little bit of action to be taken. So cash balance at the end of January, because you had a retirement payout, was $39,000 and change. We know we have $650,000 scheduled to come from UBS in April, but between now and April, we have 5, if not 6 pension pays, since police and fire is paid twice a month. So we are recommending, today we draw $560,000 down from the Loomis Sales intermediate fixed income portfolio. That brings it a little bit below target. That increases the cash balance and essentially covers us through April, when we expect the payment to come in from UBS. We would revisit this again in May just to confirm and make sure that we have sufficient coverage. But you'll see, for example, based on the $560,000 draw from Loomis, the $683,000 coming from UBS in April, which, remember, that's $650,000 of that is a redemption. $33,000 of that is the quarterly income payment. We'll need to revisit again in May because we are projecting a shortfall by July. What isn't taken into account here is if you have any guys that leave between now and May. If anybody leaves between the now and the May meeting, we're fine. Like, we basically have a buffer of about $340,000, which is two, maybe, just looking at kind of the consistent annuity withdrawal payments, that's 2, maybe 3 payments. The last one was about $124,000. But I know, for example, looking at the agenda, you've got 3 on here from an approval standpoint. So we'll definitely need to revisit the liquidity plan for police and fire in May. So it's traditionally been every 6 months. The cash flow on the employees' retirement system side is easy. I think there's been more retirements on the police and fire side. And it's not necessarily the retirement rate, because in terms of the increase in the monthly cash need for the recurring pension payment, having 3 retirements, increases it by, $10,000 a month. That's not the change. It's the annuity payouts. It's when we pay out in a given month, $200,000 to $250,000 in annuity withdrawals. That's a month of pension pays. So if we're set for the next 6 months from a pension pay standpoint, and we have 4 people leave, now we're set for the next 4 months. So that's where we're starting to find we're revisiting every quarter just to confirm that we have sufficient cash to be available.
All right, any other questions? All right, is there a motion to accept the liquidity adjustments? Motion to accept. Support.
Walker? Yes. Martin?
Yes.
Boucher?
Yes.
Dean?
Yes.
And Fairwell.
Yes.
So the final piece that we had, and this is a continuation of the discussion that we had over the course of 2018, was, so we had approved an overall rebalance and we added a small mid-cap equity allocation. And when that allocation was done, we did 100% of that allocation into a Vanguard index fund. So it's 100% passive. It just replicates the entire U.S. small mid-cap equity market. One piece that we would like and would recommend the board consider is taking what is currently 100% passive small mid-cap allocation and splitting that 50-50. So half with an active mandate, half with a passive mandate. The idea being is it's a better way to control costs, a better way to control market volatility. But within that small mid-cap arena, we find that the active versus passive decision on the large cap side is a much easier discussion because the information advantage isn't there. What am I as a research analyst going to find out about Apple that 300 other Wall Street analysts don't already know? right? But if we're talking about a small cap stock that's a supplier to Apple that's only followed by 3 analysts or sometimes 0 analysts, then the information advantage that I can find in terms of talking to management and working through financials is much greater on the small cap side than it is on the large cap side. So we've put together a search book. I have a specific recommendation, and it's interesting. This is actually a portfolio manager that historically worked with both retirement systems. So one of the legacy holdings that you had was the Loomis Small Cap Value portfolio up until probably around 2015. Prior to 2015, one of the portfolio managers on that was 2 gentlemen, Joe Gatz and Dan Thalen. Dan Thalen left Loomis Sales around about 2013 and joined a firm based in Cleveland called Ancora Advisors. But Dan's actually based in, his small cap value team is based in Bloomfield Hills. They're at Woodward and Long Lake, right across the street from Bloomfield Hills Country Club. So ironically, it is, from a process standpoint, nearly identical to what was done in his tenure at Loomis Sales. But what we found in our research and our conversations with small cap managers is Dan is one of the best that we've seen, and particularly from an encyclopedic knowledge of stocks in his portfolio and stocks not in his portfolio. Like, this is somebody that just kind of lives to do this. This is his hobby in addition to being his job. So I've provided some performance comparisons and whatnot to other competitors in that space, but what I want to walk you through, for example, on page 82, is the specific recommendation we have is the current allocation to the Vanguard Extended Market Index Fund is just over $1.8 million. So our recommendation is splitting that 50-50, so it's a $900,000 move from the Small Mid Cap Index Fund to the Ancora Small Mid portfolio. So there's no change from a stocks, bonds, cash standpoint. There's no change from a large cap versus small mid cap standpoint. This is a rebalance within the small mid cap allocation. From a police and fire standpoint, on page 83, there is just over $5.8 million in that small mid cap index fund. Our recommendation is to split that 50-50. So that's a $2.9 million allocation. So who are they and what do they do? So I'm going to flip you ahead to page 87. So the comparison I put together is essentially against 4 very high conviction small mid cap managers that we are currently working with. Ancora and their small mid cap portfolio, Clarkson Capital, which ironically is another Bloomfield Hills based manager, Great Lakes, which is based in Chicago. This team is actually based in Tampa, and Reinhardt Partners, which is based in Mequon, Wisconsin, which is a Milwaukee suburb. Anecdotally, I don't know if people are aware, there are more small mid-cap managers in Milwaukee than there are anywhere else because of the University of Wisconsin program that they have. There are a lot of portfolio managers, a lot of investment analysts that come out of that program. So from a size standpoint, these are all, from a Wall Street standpoint, boutique firms. They manage somewhere between $3 billion and almost $8 billion in assets. That is a small amount of assets from a Wall Street standpoint when you talk about managers like Loomis that manage $700 billion or Vanguard that manages a couple $1 trillion. What we like about this is these are small teams. They are very aware of capacity. They have a specific amount of assets they want to raise and invest, and they will close that portfolio to new accounts. They want to make sure that there isn't, right, to the extent they're successful, they don't continue to raise assets, which then means that investors that invested early with them are essentially penalized because they can't invest the portfolio the same way. These are all portfolio manager-led strategies, all with deep teams from an analytical standpoint. What I want to take you to is page 93. So page 93 is long-term performance comparisons for these different strategies. And they each have varying inception dates. So this Ancora portfolio, for example, has been around for a little over 7 years. But we know Dan Thalen's track record actually dates back to about 2000 because we can link, from an internal standpoint in doing analysis, we can link his tenure at Loomis Sales on the small mid-cap portfolio and small cap value portfolio, and then his tenure at Ancora, because the process that he was following was identical between those two firms. So while this only has a 7-year track record, in our view of Dan and his team versus competitors is we can look back actually almost 28 years. So what keys us in here and why versus a variety of different options we think Ancora is the best option today is in terms of longest common track record, that's the 7-year column, they're the best performer. And in terms of near-term performance, in the last year, for example, they're the worst performer. And when I say worst performer, right, in 2018, they were down 11.8. Benchmark was down 10. They ranked in the 59th percentile. This isn't necessarily a manager that was down 20% last year and was the worst from a ranking standpoint. But we think it's an attractive entry point into the portfolio and essentially reintroduces an allocation that we had 4 or 5 years ago that we believe was eliminated because of qualitative reasons, right? Dan had left at that point, and there's a lot of upheaval going on with that team. And more importantly, equally balances out what we have from an allocation standpoint in that small mid-cap bucket, that we have a firm basis from an index standpoint, and then a firm basis from an active manager that does pretty well in a variety of different markets. So that's the Cliff Notes version. I'll pause and see what questions we have.
Reinhardt seems to outperform them, right?
And my one concern, and the Reinhardt portfolio is one that we actually, when I was at Morgan Stanley in 2008, we actually came to them because they managed a small cap portfolio and they managed a mid cap portfolio. And this is actually for the city of Garden City for their retirement system. Is we asked, this is a small system. I don't need a small cap manager. I don't need a mid cap manager. Can you run a combined strategy? And that's what really started this. Their 2018 performance is so out of bounds. They were up 1%. They were 11% ahead of the benchmark. Then my concern is, right, one of the things, I think we've talked about this before, like there's the joke from a personal standpoint, the only 2 things certain in life are death and taxes. The only things certain from an investment management standpoint are death, taxes, and short-term underperformance. So each of these managers has a strict style, a strict investment process that they follow, right? If they deviate from that process, that's grounds for termination, right? We want to understand that you're building this portfolio consistently day in and day out, year in and year out, so that we understand why a name gets into the portfolio, why a name comes out. 2018 performance was an outlier for them. They actually had 4 names in the portfolio that were taken private. Performance has been so good as of late. We have the concern we have is the next 12 to 18 months should be a period of underperformance for them. I would rather look to someone right now that has underperformed a little bit as of late, still has an equal or better long-term track record than competitors in the space, but maybe in the last 12 to 18 months has underperformed their benchmark. The idea being this is a good entry point because as styles move in and out of favor, if we have a style that's been out of favor or a method for building the portfolio that's been a little bit out of favor as of late, entering now, right, we're reviewing that past performance, but we didn't experience any of that past performance, that this is arguably a good entry point into a strategy like Ancora versus Reinhardt. If we can get Reinhardt to go through a period of underperformance as their style moves out of favor, that creates an attractive entry point. I'm just candidly worried. They were the number one performer last year. Typically, when you hire the number 1 performer in the last, 1 year, 3 year, 5 year, your experience for the next 2 to 3 years is, why did we hire him? Like, what happened? Because their style shifts out of favor. Versus an entry point to somebody like Ancora right now is their style's been out of favor for a little while. We may be early, maybe it's 6 months of underperformance that we have to weather through until their style comes back into favor. But the probability of success going forward, we believe, is greater with somebody like Ancora versus Reinhardt.
would just look at the numbers and say, well, look at Reinhardt.
Yeah.
I mean, but it's hard to say what's going to happen.
Mhm.
So, I mean, can we say that Reinhardt's overperformance is based on them changing their strategy and now that strategy is going out there? We don't know by looking at this chart.
So there'd be no, right, so in any of these cases, as you look at any of these different options, and let's just keep the conversation to Ancora and Reinhardt just to make it a little bit clearer. There's been no change in how they build their portfolios. So it's not like, right, in 2018, growth was in favor versus value. So it's not like in 2018 they deviated from their investment process and bought more growth stocks in the portfolio, and that's why they outperformed. In our view, the biggest reason why Reinhardt outperformed so significantly in 2018 is there is a ridiculous amount of money. The private equity market is about $3 trillion. There's about 1 to 1.5 trillion in what we call dry powder, or money that people have committed to private equity funds that hasn't been put to work yet. Investors are paying fees on that money, so there is a push. If I'm paying you, get this money to work, get this money to work, get this money to work. So there's a ton of money from a private equity standpoint in 2018 that was chasing buyouts. So you saw a number of small and mid-cap companies that were publicly traded that became privately traded. One of the things we like about the Reinhardt process is they use private market transactions. So in every industry, and one of the examples they give is, for example, in auto parts supply, like retail stores like O'Reilly's or Advanced Auto Parts, is they go back and look over the years at private transactions. So, you know, if O'Reilly were taken private in 2017, what was the multiple, what was the valuation? And they use that transaction as a basis for setting a target price. So it's not what is the equity market, it's what was someone willing to pay cash for. You can think about it in the same way. I think I know what my house is worth. The appraiser thinks they know what my house is worth. But the actual statement of that value is, what is someone willing to write me a check for? Same with, you know, with a car or anything like that, right? The actual cash transaction, okay, that sets a basis. So they use that as a means of setting price targets in their portfolio, which puts a nice floor in. What we had in 2018 was there had a number of names that were taken out at 30 to 40% above historical purchase price and gave them a really nice boost to performance. My only concern, and this is subjective, is that because 2018 was so strong from a performance standpoint, when you see a manager outperform to that degree in a given calendar year, usually they give some of it back in the next 12 to 18 months. On this one, there isn't a black and white answer. And I think, Dan, this goes back to some of our previous conversations, like around, you had asked, I think, a totally honest and totally appropriate question, like on the Loomis Sales large cap value team, like we keep having this conversation, we keep having this conversation, we keep having this conversation. And in that case, our concern was like, there's some qualitative issues here that are just gray. This is not a black and white decision. There's some qualitative issues. We're just worried about team changes, and maybe there's some cultural issues going on that could indicate a larger concern. On this case, this is one of those, this is more of an intuitive decision, because on a black and white basis, right, 1 year, 3 year, 5 year, risk-adjusted returns, upside capture versus downside capture, like every metro you could look at, Reinhardt's the clear leader. My one concern is that because 2018 was so good, it was an outlier from a performance standpoint, that their style is due for a period of underperformance versus others in that space.
Here's a concern I have. We just decided, at least with Police and Fire, we decided to put $6 million into an index. I'm looking at the performance of the index fund based on page 93, and if you look at, for Ancora in particular, specifically, it's consistently below or at the index fund, except for the And we're trying to justify paying $3,000 a year investment fees for an actively managed fund that's not performing as well as the index fund. We're assuming more risk, we're paying more money for lower performance. It doesn't make sense to me. And we just made this decision to move $6 million into an index fund to reduce our risk. And now we're proposing that we take half of that, move it into a fund that I see has lower performance, and we're spending $30,000 a year to maintain, and assuming more risk. It doesn't, from a fiduciary standpoint, that makes no sense. And I'm not convinced that we should be looking at this. I don't know.
No, I agree with the same.
And if we were, I wouldn't pick, very simple.
I'm not even so that maybe just so.
Mike, I think it's a fair statement. What I wanted done, we've done, in terms of adding the small mid-cap allocation. In our view on this is the potential for an incremental improvement. You're right, you have to get out to the 7-year, and it's interesting. In the last 7 years, the Vanguard fund that you're in versus active peers ranks in the 32nd percentile. So top third, that's solid. It's just the difference between that top third and as you get to those that rank higher. In many cases, if you ranked in the top third versus, top 10, that difference might be 0.25%, which is largely why would I deviate from what I'm doing? But when you look, for example, at the difference between the top third and any of those 4 candidates that rank in the top decile, there's a meaningful difference in performance for those active managers, for those that have demonstrated true skill in the last few years, the last 10 years. There's been a meaningful improvement in returns above and beyond an index equivalent. But again, I go back to, I'm comfortable with where we are. This is something I'd ask to consider. This can be something we revisit in the coming meetings, just looking at other options and continuing the discussion.
Yeah, I don't want to dismiss this out of hand, but I think, we don't necessarily need to make a decision on today. But it's something that we should maybe look into it.
Perfect.
As far as, we certainly have a lot to look at.
Mm-hmm.
It's not like we need more information necessarily. But,
Just refresh this. Have it in 6 months.
I don't know, you guys think.
I'm comfortable with that. So the final piece is really just a discussion item. So there's been an evolution of the Loomis relationship in terms of having local staff, not having local staff, having more Loomis product. They were with the resignation of the large cap value portfolio. What I wanted to come back and ask was, from a historical standpoint, and this is going back, 10 plus years, is traditionally there was a Loomis sales member in attendance at every meeting, right? David Sauer would attend every meeting and give a Loomis update. David's no longer with Loomis, and really the local Loomis office is more administrative than it is any type of real client-facing. Like those individuals that remain in the Bloomfield Hills location that were client-facing have all retired in the last year. So Chris Lazaro was the rep assigned by Loomis. Chris is based in Boston. But Chris has said, from a review standpoint, we're happy to do whatever. So I wanted to bring the question to these boards and say, what do you want? What would make you comfortable? In many cases, we would do an annual review. You know, in the past, we've had UBS in, or we've had Vontable in. That's usually been around a period of underperformance. Come and tell us what's going on. We want to have a better understanding and hear directly from the manager, you know, why performance has been what it's been. But I also know that there's been a long-standing relationship with this body and Loomis, and want to make sure that we are conscientious to that. Do we want to bring them in August for a review, or November or May? Like, bring them in once a year? Like, what would you be most comfortable with? We don't have to bring them in at all. That's also an option for you.
It's basically just
The two fixed income portfolios. Mm-hmm.
Where are we now? We have them coming every 6 months. It wasn't every meeting. It wasn't every meeting.
Well, David
Mm-hmm.
Yeah, because that was when we had,
yeah.
much more.
Right.
Yeah.
I think once a year's fine. But I don't know. Travel from Boston north of that for this.
What's the average for other pensions?
Annual.
Type of manager?
For something like that, it's an annual review. Mm-hmm.
I don't want to say we just never need to see him because there's still money there.
Right. So where we see a lot of boards going, look at the end of the day, as your investment consultant, we're responsible for all of these. If there's something going on from a qualitative standpoint in between meetings, that's something we need to make you aware of and provide an opinion on, right? If there's a portfolio manager departure from the Vontable International Equity Fund, that's something we need to evaluate and make sure that this board is aware of. We have boards that we work with that do annual reviews with their investment managers. We have boards that we work with that do what I'll call occasional reviews. And it's usually, hey, something's going on from a performance standpoint, good or bad. We want to bring them into the next meeting and have a conversation about it. Something's happened from a qualitative standpoint within the organization. We want to bring them in and have a conversation about it. So I'd say door number one, door number two. Door number one is, let's set up annual reviews. Door number two is, we are going to do regular reviews. That could be once a year. That could be they're here in May and they're here again in 18 months, just based on what's going on with the portfolio, what's going on with the markets. It's kind of thing where your board meets every 3 months. So if we made a decision today that we wanted to review a manager, you have given them infinitely more notice than is common. What happens a lot of times is, we're meeting in 2 weeks, we need you there. And these individuals are used to it, right? They travel 4 days a week, all over the place. So your compassion towards, hey, he's in Boston, we only want to bring in once a year and we want to give him less notice, like, that is the exception, not the norm. The norm is usually, I'm paying you a lot of money, be here next month. Okay. We'll work to get them scheduled this year then, between the next 2 meetings. Perfect.
Thank you.
Anything else on that?
That's all I have. Thank you.
All right, the next items are accepting and reviewing the retirements for Dan Simon, Robert Farrar, and Tim Collins. Do you do them individually or do you do them with?
I would move to accept. No, we need to make a motion for the reallocation on the review. Okay. We don't need to.
All right, at the retirements, I believe the mayor made a motion. Support.
Martin,
Yes.
Piche,
Yes.
Dees,
Yes.
Mayor Longfellow.
Yes. And we say that, Margaret, go ahead.
I should say I don't have minutes, I don't.
I'll let me move those to the next meeting. All right.
The next meeting being,
It's 7:30.
7:30
yes,
on
We
first
don't know the
Thursday.
date. You know the time.
first Thursday and second. Is that right?
It's the second. The first one.
May 9, 7:30.
Okay, no.
Should I say first?
May 2nd.
May 2nd. Is that correct? Is that right?
I don't know this right, we don't get the time.
Thank you.
Second. Yeah.
Which is rare, usually.
And that'll be at 7:30.
That's up.
All right, is there any other business before? All right. Please adjourn.
Excellent.